Now, PPI. Expectation is 0.02. We are looking for core 0.2 headline, and 0.1 for minus trade. Oh, we got a miss. Instead of 0.2, we get 0.1. Let's go. Instead of 0.2, we get a 0.1. And instead of 0.1, oh, we actually do match. We get a 0.1. Final demand year over year. Oh my gosh. Instead of 0.4, we get 0.1 as well. All of these numbers are just absolutely a complete beat in the good direction, as in this is what we want. Let me reiterate this. This is insane. PPI final demand month over month was expected to be 0.2. We got half. We got 0.1. Final demand X food and energy. So in other words, the headline month over month number came in under expectations. The core number X food and energy comes in under expectations at 0.1 versus 0.2. Then you get core, which is the refined core, food, energy, and trade excluded. You're at 0.1. And then you get year over year for the figure. Folks, the year over year number, it was supposed to be 0.4, basically flat. And we actually nearly get flat at 0.1. Oh my gosh. PPI X food and energy year over year, so this is your core, comes in at 2.4 versus 2.6. And then your refined core, where we also exclude trade, matches the 2.6 estimate, down from the prior of 2.8. This is phenomenal. This comes at the same time as Delta earnings are much better than expected. Not only are Delta earnings much better than expected, but we're seeing more gasoline disinflation combined with stronger growth expected for the next quarter. Now we get initial jobless claims at 237,000 versus the expectation of 250,000. In other words, less jobless claims than expected. And continuing claims came in a little bit hotter than expected at 1.729 million versus the 1.72 that was expected. But oh my gosh, these numbers are very good. Oh, oh my gosh, this just came through the tape as well. Oh my gosh, it just keeps getting better. Stop it, stop it. This is ridiculous. Now the prior PPI numbers have been revised. The prior PPI month over month number was expected to be 0.3. What did we, a negative 0.3? We got negative 0.4. That's because we had this massive fuel decline. Then you have core month over month, excluding food and energy, that previously was expected to be 0.2, which has been revised down to 0.1. The X food, energy, and trade month over month number was 0.0, and they left it at 0.0. The final demand year over year number, although actually no, I don't have a revision at all yet, so I'm assuming that's left at 0, but I'll let you know if that changes. PPI final demand year over year previously was 1.1. Now it's revised down to 0.9. Oh my lord. Previous X food and energy year over year was 2.8, revised down to 2.6. Holy crap. In other words, this is fantastic. We started this day out saying, look, the worst thing that could happen right now is you not joining the programs on Building Your Wealth and all of the course member live streams where we look at leading indicators all day long, every single day, or stock buy sell signals. Oh, sorry, that's not actually what I was supposed to say. I was supposed to say the worst thing going into today was a potential miss for PPI. Because if we missed PPI being a leading indicator for CPI, we would have literally undone what we got yesterday and crashed the market. We would have taken all the good news of yesterday and crashed the market with a bad PPI print this morning. But no, we didn't even just get a benign PPI report this morning. No. That's a scam. It's too good. We got a substantially better than expected PPI report with a completely revised lower previous PPI report. This is insane. Take a shot every time I say PPI. Okay, no, don't do that. Holy smokes. Let's look at some of the actual items here. So, okay, wow. This is absolutely incredible. So let's get into some detail here. So, the index. The indexes for food and alcohol retailing, traveler accommodation, insurance, hospital and patient care, and airline passenger services moved higher. Conversely, prices for truck transportation and freight declined 2.1%. The indices for food and alcohol wholesaling and for residential real estate loans also fell. I mean, residential real estate loans, that's not a surprise. Your volumes in residential real estate are just complete trash. Because even though prices are up, it is very, 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 very difficult to get volume in real estate right now. So that is going to lower your potential here for strong earnings or strong fees at some of these mortgage providers, right? I mean, think about it. Mortgage providers are undercutting their fees just to get some food on the table. Just to give you a little bit more insight into that. I used to be a loan originator. Prices for final demand goods were unchanged in June after decreasing 1.6% in May. Final demand, an increase in the final demand for energy of 0.7% offset falling prices for final demand goods, less food and energy, which declined 0.2%. So in other words, continued goods deflation, actually. You have energy that actually popped up a little bit in this last month in the PPI report. And then you're still seeing the same area that you would expect be somewhat strong for producer prices, which is going to be your hospitality, your insurance services, and your travel services for airlines. This is somewhat expected. Again, the headline numbers all coming in way lower than expected. Looking for a little bit of reaction here from the suits as well. What I'd like to also get is a little bit more of a particular breakdown. We're going to get that in just a moment. But here's a comment already. PPI affirmed the messaging from yesterday's consumer report. Exactly. That's exactly that's why I started this segment off today, this Meet Kevin report with, look, PPI could literally screw us today. Fortunately, didn't get screwed. Knock on wood. This is good. Okay? This is not how you would want to get screwed, even if you were inclined to be. PPI affirmed the messaging from yesterday, with headline and traditional core undershooting expectations. On the flip side, initial jobless claims did come in lower than expected, suggesting that any labor market deterioration is proceeding at a very gradual pace. That's a pretty happy backdrop for risky assets. Moderating inflation and moderate growth is about as Goldilocks as it gets these days. No kidding. Not only is it about as Goldilocks as it gets these days, but I'll tell you, and I'll do this while I'm pulling up the... I want to get a little bit more into some of the charts for this. But some of the bears yesterday were commenting that inflation overall seems to be getting substantially less sticky. I commented that it seems to me the bears are starting to capitulate, but I thought this was an interesting one. Now, I've made comments on macro wealth here before, and I was a little frustrated that I haven't really gotten a response to some of the bearish charts that the individual has posted on Twitter, and I've reached out multiple times, but whatever. He's generally been very bearish, and posted this: Powell's preferred inflation measure using core CPI services ex shelter. Here are the 3-month annualized rates. These are for consumer prices, not to be confused with the producer prices we're reviewing right now. But anyway, looking at this, what does he say? Well, he tells us that, okay, in January, we had a 4.1% level of a 3-month annualized inflation rate, which increased to 5.1, increased to 5.2 in March, decreased to 4.1 in April, decreased to 3.0 in May, decreased to just 1.4% in June, to where now he's making the argument that, quote, starts to look very unsticky to me. The last thing the bears had was that inflation would be sticky, forcing the Fed to continue crimping this economy and destroying what has proven to be the sexy Nike swoosh recovery that we've gotten in markets. And the Nike swoosh recovery has been so amazing. Some people have been sending me emails and letters going, Kevin, you got to stop calling it a Nike swoosh because Nike's going to get mad. And I'm like, bro, why would Nike be upset for being associated with deliciousness? And then they're like, well, the short sellers are going to get mad. And then I said, well, that's something everyone can get behind, isn't it? Anyway, so finance. You gotta try to have entertainment where you can. Okay, it's otherwise it's giddy. So, final demand for goods Let's look at just the right column here. Our seasonally adjusted May to June change. Month over month, final demand, 0.1. It's nothing. All these people on yesterday tweeted that inflation is transitory, which we've been talking about for quite a while. But anyway, people got so mad at me. They're like, well, the grocery store disagrees. And I'm like, good Lord. Most people really still have this fundamental misunderstanding that inflation coming down does not mean prices are coming down. It's this complete disconnect from reality that actually makes me very happy because it means I get to buy stocks at lower prices while people actually still think inflation is a problem. Whatever. Final demand for foods is actually deflationary here via PPI at negative 0.1. Let's look at some of the more headline characteristics here without going too deep. Household furniture, 0.2. Okay, let's just point out some of the items here. Tires, negative 0.3. Thank God. Cosmetics, still hot. 0.4 on cosmetics. You know, Ulta's just been a stock that's been killing it. I wonder if they still are. Oh, yeah. Ulta at 484. They've had this crazy trading range, though. Look at this. This is like a beautiful trading range. It's a really wide wedge is what I've been defining it as. Look at this rejection and then the bounce. I mean, it's almost perfect, this trade range that we've got for Ulta. And it looks pretty sexy right now. And seeing that over here on PPI potentially indicates some leading pricing power there at Ulta. It's been one that I keep looking at. I'm like, this has got to roll over at some point. Hot off the press, SEC sues Celsius. Oh yeah, more crypto lawsuits, baby. That's ridiculous. We just need some rules from Congress, but they don't even know what they're doing. It's ridiculous. They didn't know what they were doing during COVID either. We all knew that. Who were tracking Congress every day. It was ridiculous. Look at this. Electronic computers and computer equipment down again, 1.6%. It's not so great for indicating some leading surge from AI here. That's potentially actually a little bit of a leading downside indicator. I would have thought I would have seen at least some kind of strengthening versus the previous numbers, but no, not getting that at all in the technology segment. X-ray equipment, 0. Oil and gas machinery, 0. Floor coverings, negative. Commercial furniture, negative. Household appliances, these are your durables, this is nothing. Passenger cars, down 0.7%. Lawn and garden equipment and tractors, down. As your John Deere, basically. Look at all these zeros here. I mean, this is just beautiful. Aircraft, what did I tell you? One of the places you have remaining inflation is aircrafts. Aerospace is very difficult. That is one of the last holdouts for inflation. It's incredible. So then we've got mobile homes. Oh my gosh, who cares? 0.2. Railroad equipment, toys, games, and children vehicles, sporting and athletic goods. Okay, medical, surgical devices, those are all 0. Medical, surgical, and personal aid devices, 0.8. Yikes. A little hot over here, although the weight on this is, I believe, relatively small. Let me see if I can get the weight. Group code, item code. We don't actually have a weight listed on this. Probably very small, though. Final demand services. This is where you do not want to see escaping inflation. What do we have over here? 0.2 for final demand services. Fantastic. Really, really good. This is despite food and alcohol retailing up 2.3%, offset by 2.3% to the downside for food and alcohol wholesaling. And apparel wholesaling is down. Okay, look at that. Computer hardware, software, supplies retailing, down almost a full percentage point in just a month, folks. RVs up, though. That might not be a surprising summer expense. I think a lot of people are taking money out of home equity lines of credit, and they're jumping into, whatever they want, whether that's, buying travel, paying down other debt and consolidating more expensive debt, or potentially RV travel. So look at maybe some of the stocks like Winnebago to see if we can get some leading indicators from them on what's happening going forward with the market. Winnebago reports next. Oh, what do they report next? Oh, I don't know. That's a little bit difficult to figure out right now. That's WGO. Okay, we can figure this out. Hold on. Looking at another comment here from the suits. If yesterday's CPI data caused traders to all but eliminate the probability of a second rate hike after July, today's data may cause them to bring forward cuts. But assets seem reluctant to move much. Maybe there just isn't much further to fall after the July 26th FOMC meeting in terms of how long we're going to stay high with rate expectations. PPI surprised, obviously, all over. Okay, WGO for Winnebago. The next earnings set for Winnebago, which is a section we're seeing some potential inflation here, is June 21st, which just happened. And then you have October 17th. So that's if you're looking at Winnebago. If you're looking for Ulta, which could be a pretty big catalyst, especially for them, especially since you're seeing such a move in PPI for cosmetics. The next Ulta report is August 24th. All right, continuing. Final demand, transportation and warehousing, negative 0.9. It's fantastic. I'm really honestly just going to start looking for the problem ones here because everything's just down. Airline passenger services, I was expecting this to be up yesterday in CPI. It was negative in CPI, air traffic revenue or air ticket revenue. Maybe you'll get a little bit of a bump here because of PPI leading a 1.1% bump. Wouldn't surprise me since I do think there's a chance you're going to get a core services bump for July and August because of probably hotter travel than the seasonal adjustment will take care of. All right. Application software publishing, 0.8%. Wonder what this has to do with AI. Pay attention to that. All right. What else do we have here? Negative 0.27 in consumer loans. Deposit services up 5.4%. Oh, getting a little more expensive to handle your banking. Property and casualty insurance. This is a problem. Full 2 percentage point bump here. And it's been hot. So insurance is still running up. It's likely, though, insurance is a very lagging indicator. Because think about it. You would see your goods prices go up. Then you would see your construction services prices go up. And only after those things go up are you going to see insurance services go up. And those items, goods and services, could actually be coming down. And you'll still see insurance services going up because they are adjusting to a new reality of a lot more expenses. And this happens with a lag. Obviously, insurance companies are going to try to price this in as much as they can up front, but you also have to wait for renewals. You can't just call everybody up and go, all your rates are going up today. You have to wait for the contracts to renew. Yeah, not great. All right, not great, but explainable. We'll put it that way. Travel accommodation services up 2.3%. Yeah, I think you're going to get a core boost in CPI next month because of travel. I'm not going to hold my breath on a for sure miss on the next one. But this so far is fan-frickin-tastic. This is very good. Here's some of your energy products, almost all negative. Organic compounds negative. Some of these other byproducts of oil production. Paper up 0.4%. Yeah, but this is actually the lowest increase that you've had in the past few months. You've had substantially higher increases over here. Okay, so that's actually a slowdown. Good. What else? Let me see what else we have, and then I want to get into some more commentary on these numbers here. We're getting into some more of the raw building materials here. Looking across, but look at that. Services for intermediate demand, 0. Flat. No inflation. How is the postal service coming up as 0? They just raised, what's it called? Stamp prices. Advertising sales, 0. This is despite the fact that Trade Desk just hit a 52-week high. I've got some personal exposure to Trade Desk. Wow. It's just, I was not expecting Trade Desk to rip like that. But I like the exposure I have to it. Do like Trade Desk. I like Trade Desk, but wasn't expecting that rip. Wow. Okay. All right. The rest goes on. What else do we have here? Non-residential management fees for commercial property management, fine. Staffing fees. Just trying to see if I could get anything to really tell me I'm looking at something scary here, even in services. And I'm just not seeing it. It's either in lagging segments or or travel here. Airline passenger services. That one's hot. It's there and it's in insurance, but otherwise we're broadly negative. So this is fantastic. I'm going to look for a little bit more commentary from Wall Street here. So, okay, this is great. Let me see if I got any other revisions in the economic data. No, everything's a miss the way we read it off, so rewind if you missed that. Okay, so that's really good. Okay, U.S. producer prices rise at the slowest pace in nearly 3 years, extending a months-long decel in pipeline inflationary pressures. Wow. Normalizing global supply chains, stabilizing commodity prices, and a broader shift in consumer demand towards services away from goods have generally helped alleviate inflationary pressure at the producer level. Services costs edged higher despite a sharp decline in transportation and warehousing costs. Right, we just went through specifically which. Some of those insurance, some of the airline travel, but then also software development, but not in the computer products. Software. Prices of goods, meanwhile, little change. That's flowed through to consumers in the form of lower prices, known as deflation. Imagine that. Excluding the volatile food and energy components, core PCE barely rose. And we saw that. These are... Jerome Powell is going to get his monument for sticking a soft landing here. Figures come out just a day after consumer prices rose at the slowest pace since 2021. While a July hike is all but assured, the rapid descent in price growth, now just a third of its 2022 peak rate, offered fresh hope that the Fed can soon wrap up the most aggressive tightening campaign in decades. No kidding. Let's do our favorite analysis now. And let's look at the 5-year break. When is too much deflation a problem? Oh, don't worry. Don't worry. Do not fall into the bear trap of suggesting we're going to have a deflationary problem. We will print our way out of deflation. I promise. We will print our way out of deflation. And then people are going to go, wait a minute, it shouldn't be like this. It's all rigged. Maybe it is. But you got to learn how to play the game. And the game is, they're going to print money. And if it doesn't cause inflation because we're actually avoiding deflation, so be it. At some point, all currencies collapse. The dollar will be no different. At some point, the dollar will collapse. But knock on wood, that time is no time soon. 5-year break even, actually sitting up a little bit at 2.19. It's quite interesting. Fed terminal rate expectations after PPI and CPI now sitting at, drum roll, 5.3375, basically fully pricing in one more rate hike and nothing thereafter. If we look at the futures rate monitor tool, we are looking at a Fed meeting in 1 week, 6 days, and 5 hours. That does align with the expiration of Meet Kevin's coupon code, which you can now use if you're a course member to get a pretty big discount on shadowing with me as well. I expect shadowing probably for nearly the rest of the year to be booked out within the next 2 weeks, if not before that. So check that out at meetkevin.com. You basically get tiered discounts based on how many courses you have. So the more of a bundled up course member you are, the more of a discount you get for shadowing. Yeah, it's a big benefit to existing course members. As always, I try to add more benefits to existing course members as prices go up over time. They lock in their prices and value, and the same could be true for you if you join before the next price increase. On July 26th, we're sitting at a 91.8% likelihood of a 25 BP hike with an 81.7% chance we are going to stay there by September. We are looking for our first cuts by about March, with an over 72% chance that we have at least one cut in March 2020. This is phenomenal. Absolutely great news. Also, by the way, interested to have anybody on Twitter Spaces chat in if you'd like to jump in on Twitter Spaces. We're now streaming on Twitch, Twitter Spaces. We're also streaming on Twitter via live video. So if you want live video or you want Twitter Spaces, you can join, which is phenomenal. Actually, a lot of that is thanks to StreamYard. If you have not yet checked out StreamYard, make sure you go to metkevin.com/StreamYard. Allows me to multi-stream to different platforms at the same time, as well as throw out comments up on screen. Some of these we'll talk about a little bit later. Don't hate the player, hate the game. There you go, exactly. The Prepper Ninja nails it. Absolutely right. So, that does it for PPI. Absolutely phenomenal. Now, we do have some other things to cover.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by